Hello friends, we are on day 10 of our quick revision batch. Slowly we are moving towards end now. In today's lecture, we'll try to cover chapter 12, that is marginal costing. One of the important chapters for CA final also. Right? So chapter 12, marginal costing, we'll try to cover today. In this chapter, we will revise division of cost. All of you are aware, in marginal costing, we divide the cost into variable cost and fixed cost. So we'll see the division of cost, then we'll see the behavior of cost, how the variable cost behaves and how the fixed cost behaves. And we will also discuss important formulae which are used in marginal costing to solve the questions. So we'll try to revise almost all the important formulas. So let's go ahead. First of all, marginal costing is a technique used for managerial decision making. Marginal costing is a technique, and this technique is designed for managerial decision making. In CA final, majority of your syllabus is related to decision making. So here in intermediate, you will be studying this technique, just the basic formulas and concepts. And then application of this technique for majority of the decision making, you will see it in CA final. Now this technique recognizes only two types of cost, that is variable cost and fixed cost. So this technique believes that all the costs are divisible in two parts, either variable or fixed. Now you may say if there is a semi-variable cost, that is partly variable and partly fixed, then what will happen? So if there is a semi-variable cost, then it needs to be subdivided into variable and fixed portion separately. So if in the question they give you variable cost, a semi-variable cost or semi-variable overheads, using the formulas or tricks, you have to divide that cost in two parts, include the variable portion in variable cost and fixed portion in fixed cost. It means to solve any question of marginal costing, first, the data given in the question has to be splitted in two parts, into variable cost and into fixed cost. If it is already given in that format, very good. But most of the time, institute may not give you the ready-made data. So you'll have to split the data into variable and fixed cost. Now, what is this division of cost? If you remember, for cost sheet purpose, we had seen the total cost was divided, for cost sheet purpose I am saying, in two parts, that is prime cost and overheads. For cost sheet purpose, prime cost was your direct material, direct labor, direct expenses, and overheads was indirect material, indirect labor and indirect expenses. This is what we have already seen. And we used to divide overheads also further in three parts, if you remember, that is factory overheads, administration overheads and selling and distribution overheads. But for marginal costing purpose, we will divide the overheads only in two parts, that is variable overheads and fixed overheads. This is the division of cost for marginal costing purpose. Now, you'll say then what will happen to factory overheads? There is no problem. Factory overheads may be there, but you have to split the factory overheads into two parts, variable factory overheads, fixed factory overheads. If there are administration overheads, split it in two parts, variable administration overheads and fixed administration overheads. Selling and distribution overheads again in two parts, variable selling and distribution and fixed selling and distribution. It means we want all costs to be classified into variable and fixed. Now please remember, your prime cost being a direct cost, that is direct material, direct labor, direct expense, it is directly associated with cost object. So it has got one-to-one relation with the cost object, that is with the product which you manufacture. Therefore, prime cost by default is variable cost. All prime costs by default are variable cost. It means in the question, if they tell you direct material, it is variable cost. If they tell you direct labor, it is variable cost. If they give you direct expenses, it is by default variable cost. So this prime cost is always variable, plus out of overheads portion, you have separated out the variable overheads portion. So these two together, that is prime cost plus variable overheads together, becomes your variable cost for marginal costing purpose. So your variable cost for marginal costing purpose is prime cost plus variable overheads, and your fixed overheads is the only fixed cost. Now this fixed overheads may include factory fixed overheads, administration fixed overheads and selling and distribution fixed overheads. So fixed overheads and fixed cost is one and the same in marginal costing, but variable cost includes prime cost plus variable overheads. In variable overheads, You will have variable factory overheads, administration overheads, and selling and distribution overheads. So all variable portion of overheads plus prime cost becomes your total variable cost. This is the division of cost which is required to solve every question of marginal costing. Now we go to the behavior of cost. How the variable cost behave and how the fixed cost will behave. So I am taking behavior of cost vis-a-vis production. Vis-a-vis production means vis-a-vis level of activity, right? So I am taking variable cost and fixed cost. Variable cost I am taking two types. One is variable cost per unit. I repeat, variable cost of 1 unit, and total variable cost. Means two types of variable cost I am taking. One is variable cost per unit and one is total variable cost. Fixed cost also I will take two types, per unit fixed cost and total fixed cost. Now I will increase my production. You suppose my present production was 10,000. From 10,000 units I have started producing and selling 15,000 units. 15,000. So my production activity has gone up. With increase in production, what will happen to variable cost per unit? What will happen to variable cost per unit if my production goes up? My dear friends, you may be able to remember now because you have studied it in regular batch already. Variable cost per unit always remains constant. Per unit remains constant. It means if to manufacture one piece of output, if this is my one piece of output, if the variable cost is 50 rupees, for one piece it will remain 50 rupees. If I produce two pieces, then 50 rupees per unit into 2, it will be 100. If I produce 10 pieces, then 50 rupees into 10, it will be 500. It means what will increase is total variable cost will go on increasing with increase in production. So total variable cost increases with increase in production. However, per unit variable cost always remains constant. Now what will happen to fixed cost per unit now? With increase in production I am saying. Increase in production is common now. With increase in production, what will be the impact or what will be the behavior of fixed cost per unit? Will it increase, decrease, or will remain same? Please remember, it will decrease. It will decrease. Now you will say, no sir, it is a fixed cost. Fixed cost always remains constant. You are right. Fixed cost will remain constant, but total fixed cost will remain constant. Please remember, total fixed cost will remain constant. But if you divide total fixed cost by number of units produced, I repeat, total fixed cost will remain constant, that is numerator, divided by number of units produced. If that denominator, number of units produced, if it increases, naturally the per unit burden of fixed cost will decrease. Per unit burden of fixed cost will decrease. So with increase in production, fixed cost per unit will decrease. For example, there is a factory rent which is payable at the rate of rupees, let us say 10 lakh per annum. 10 lakh per annum is the rent of the factory. Now this rent will remain constant for the year, that is 10 lakh. Now this 10 lakh rent is divided by number of units produced in the factory. If that denominator is 1 lakh units, so 10 lakh rupees rent divided by 1 lakh units, the cost per unit will be rupees 10. But if my output of 1 lakh unit becomes 2 lakh units, however total rent will remain constant. This total fixed cost will remain constant. Rent I am taking as an example of fixed cost. So total rent will remain 10 lakh, but divided by 2 lakh units if you do, you will get just 5 per unit, which was earlier 10 per unit. Now you will get 5 per unit. So fixed cost per unit will decrease with increase in production. However, total fixed cost will remain constant. Now I will decrease my production. It means from present level my production goes down. If production decreases, what will happen to variable cost per unit? Dear friends, variable cost per unit will once again remain constant. Then what will decrease? Total variable cost decreases with decrease in production. What will happen to fixed cost per unit? Fixed cost per unit will now increase because production has decreased. The denominator decreases, the value or answer will increase, per unit cost will increase. However, total fixed cost will remain constant. So my dear friends, there are two constants in marginal costing. What are these two constants? Variable cost per unit is constant and fixed cost total is constant. Variable cost per unit is constant and fixed cost total is constant. And to solve every question, you have to find out these two constants first. From the data given in the question, you have to find out variable cost per unit and fixed cost total. Once you get this data, you can solve the questions very easily. So this is the behavior of cost. This behavior of cost is also known by a name, CVP analysis. CVP analysis stands for cost, volume, profit analysis. Cost, volume, profit analysis, which means what is the behavior of cost and profit due to change in volume? CVP, that is cost, volume, profit analysis, means you have to see or check the behavior of cost and profit due to change in volume. It means due to change in volume of production and sales, what is the behavior of cost and profit, how they behave. That is what we have discussed just now. So whatever we have discussed just now is also known as CVP analysis. Therefore, marginal costing has got one alternative name known as cost, volume, profit analysis. It's another name for marginal costing technique. Now we'll discuss the important formulas. The golden formula of marginal costing, all of you are aware, is a sales minus variable cost is equal to contribution. From sales, if you deduct the variable cost, you get contribution. And from contribution, if you deduct a fixed cost, you will either get profit or loss. For example, if my sales is 10 lakh, variable cost is 6 lakh, my contribution will be 4 lakh. From 4 lakh, if I deduct my fixed cost, suppose fixed cost is 3 lakh, the profit will be 1 lakh. Profit will be 1 lakh. And if my fixed cost is 5 lakh, then it means fixed cost is more than contribution. Then instead of profit, it will be a loss. 4 lakh minus 5 lakh, 1 lakh will be a loss. Now, can we say that profit is excess of contribution earned over fixed cost? Profit is excess contribution over fixed cost, and loss is excess fixed cost over contribution. Loss is excess fixed cost over contribution, or you can say unrecovered fixed cost, which could not be recovered from the available contribution. So this is what is written here. We can say that excess contribution over fixed cost is profit. Profit is excess contribution over fixed cost. And excess fixed cost over contribution is loss. Mathematically, loss figure will be negative and profit figure will be positive. That is mathematics. This is the golden formula. And whenever you present a profitability statement of marginal costing, you have to always present it in this way. Only it will be in vertical format, like particulars and rupees column. And in particulars, you will write sales, then you will deduct the variable cost, you will calculate contribution, you will deduct fixed cost, and you will get profit or loss. So the same formula is presented in a statement format with data in case of marginal costing. Now, we will reshuffle this formula, right? We will reshuffle the first formula. The first golden formula is sales minus variable cost is equal to contribution. Now let us reshuffle it. I call it as 1 2 ka 4. Now contribution I am bringing to this side and variable cost I am taking to this side. See what will happen. The formula will become sales minus contribution, and right hand side you will get variable cost. Variable cost now will become positive. So formula will get reshuffled as sales minus contribution is equal to variable cost, or sales is equal to variable cost plus contribution. Shift this contribution here. So it will become variable cost plus contribution. So sales is equal to variable cost plus contribution. I am not doing anything great, my dear friends. You can also do it. But you have to remember. See, this formula everybody remembers. But you can reshuffle the formula and make 2 more formulas. Because sometimes in the question, variable cost might be missing. Sometimes in the question, sales might be missing. So you should be able to calculate it from your original formula, just for reminder purpose. Now I'll take the second one of the golden formula. Second formula was contribution minus fixed cost is equal to profit or loss. Now here profit is positive figure, loss is negative figure. Now we'll reshuffle this. Now I'm assuming there is a profit. It means right hand side figure is positive. So assuming that we are earning profit, now we'll reshuffle the formula and you will get like this. Contribution is equal to. Now shift your fixed cost to right side. So it will become fixed cost plus profit. So contribution is equal to profit plus fixed cost. If contribution is missing in the question, you can calculate using this formula. Or contribution minus profit is fixed cost. Shift this profit to this side. So contribution minus profit is fixed cost. Sometimes in the question this fixed cost is missing. So it should click to you, contribution minus profit. Now you don't have to remember these formulas by heart. Remember the original formula, but use it skillfully. Shuffle it and use it in the given question. Now I'll assume that there is a loss. Loss means right hand side was negative. This one, this loss. Now contribution is equal to fixed cost minus loss. This fixed cost is moving to right side, will become positive, but loss was already negative. So fixed cost minus loss can be called as contribution, or contribution plus loss. You shift loss to this side. Contribution plus loss is equal to fixed cost. So from one formula you can design multiple formulas. That's why I have given the name 1, 2, 4, right? So all these you can do. Actually whatever I'll discuss, you can make much more formulas just on a piece of paper. Sit sometimes with a rough piece of paper and a pen, right, and write down all these formulas and reshuffle them n number of times. You'll get lot many other formulas and you will draw some more conclusions. You have to do that as a practice for remembering the formula. Write it on a piece of paper. Now profit volume ratio, important ratio, popularly known as PV ratio, right? Profit volume ratio, that is PV ratio is equal to contribution divided by sales and into 100. Into 100 is just for converting this ratio in a percentage. Even if you don't multiply by 100, it is one and the same. So that will just convert it into percentage. So basically it is contribution to sales ratio. It is contribution to sales ratio known as profit volume ratio. Now check. We divide sales in two parts. See, sales minus variable cost will be equal to contribution. Okay, or sales minus contribution will be variable cost, or variable cost plus contribution is equal to sales. That you know now, right? So variable cost plus contribution is equal to sales. Now if variable cost is divided by sales, means variable cost in the numerator, sales in the denominator. Variable cost divided by sales into 100, you will get a ratio. You will call it as variable cost ratio. And if I take a contribution in the numerator and sales in the denominator, so contribution upon sales is PV ratio, which is already written above. So variable cost divided by sales is variable cost ratio and contribution divided by sales is PV ratio. Now try to understand some speciality about these two ratios. The total of variable cost ratio and PV ratio, the total of these two ratios will always be 100%. Naturally, my dear friends, if variable cost is 60%, PV ratio will be 40%. If PV ratio is 30%, variable cost ratio will be 70%. Because there are two parts of sales. Sales is your denominator, that is 100. When we calculate percentage, the denominator becomes 100. If sales is 100 and one part of sales is variable cost and another part is PV ratio, naturally the two ratios total will always be 100%. So if one ratio is given to you, variable cost ratio, you can instantly get the PV ratio, or if PV ratio is given to you, you will instantly get the variable cost ratio. So that is what you have to remember. So these two ratios are complementary to each other. Complementary means the total of these two ratios is always 100%. One more speciality is, for a given question, these two ratios will remain constant. These two ratios will remain constant for a given question unless you change the data. Now you will say how it will remain constant. So let us assume that sales price of 1 unit is 100 rupees. Sales price of 1 unit is 100 rupees. And variable cost is 60 rupees per unit. Now we have already seen that variable cost per unit remains constant. We have already seen that variable cost per unit remains constant. Similarly, there is one more assumption in marginal costing, that selling price per unit also remains constant. See, unless you change it. If they change it in the question, then it's different. But the silent assumption or default assumption of marginal costing is that sales price per unit remains constant. So my dear friends, this is constant and this is constant. So your contribution per unit will also remain constant, 40 per unit. Now if these three figures have become constant, don't you think the ratios will also remain constant? So in this case, the variable cost ratio will be 60% and PV ratio will be 40%. This will happen due to the assumptions which are already imbibed in marginal costing. But it doesn't mean it will remain constant for lifetime. If you change the sales price, naturally the ratio will change. If you change the variable cost per unit, naturally the ratios will change. But in absence of information, I repeat, in absence of information, sales price per unit remains constant, variable cost per unit remains constant, contribution per unit remains constant, and therefore variable cost ratio and PV ratio will also remain constant. This is in absence of information, please remember. Now we will reshuffle the PV ratio formula. So PV ratio formula can be reshuffled to get two more important formulae. Think over what was the original PV ratio formula. It was contribution upon sales, correct? Was PV ratio. Now reshuffle it. Can we get like this? Now see what I have done in the formula. Sales I have shifted to other side and PV ratio I have shifted to denominator. Like this, PV ratio going here and sales going here. So sales is equal to contribution upon PV ratio. If you remember your accounts gross profit ratio, it is something similar to that. See, in accounts you used to calculate gross profit upon GP ratio. Gross profit upon GP ratio is sales. It is similar to that, contribution upon PV ratio. Contribution approximately is similar to your gross profit in accounts and PV ratio is approximately similar to your gross profit ratio. Not exactly I am saying, but approximately, right? So conceptually it is similar. So sales is equal to contribution upon PV ratio is 1 and sales into PV ratio. If you multiply sales with PV ratio, sales into PV ratio is contribution. Like sales into GP ratio. If you multiply sales into gross profit ratio, you will get gross profit, correct? Similarly, sales multiplied by PV ratio, you will get contribution. So again, this was nothing great, just shuffling the original formula and getting two more formulas. Now let us discuss break-even point, BEP. It is the point at which there is no profit, no loss. This point means it's an activity of sales. It is the level of sales at which there is no profit to your organization, neither there is a loss. Means you sell as many units that you reach a stage where there is no profit, no loss. Then such point of sales where there is no profit, no loss is called break-even point. It means at BEP, total contribution is equal to total fixed cost. Now you will say, how come this is? See, profit or loss is 0. Then we have just now seen the formula contribution minus fixed cost is profit or loss. Contribution minus fixed cost is profit or loss. Now if this profit is 0 and you shift fixed cost here, 0 plus fixed cost means fixed cost. So it will become contribution is equal to fixed cost. So total contribution will become equal to total fixed cost only at BEP, my dear friends. This equation holds true, contribution is equal to fixed cost only at BEP, break-even point. Now management is interested in knowing break-even point because the first objective of management is to achieve or to cross break-even point. See, any organization would first like to achieve break-even point, means reach no profit, no loss situation and then go ahead. Because if you are ahead, then you will make profit. If your sales is below BEP, then you will be suffering a loss. So you should know that limit which you have to cross, right? Sales, if it is below BEP, you are into losses. Sales above BEP, you are into profit. And exactly at BEP, there is no profit, no loss. So it is important information. Management wants to know this break-even point because first objective is to cross it. Like in your examination, in every paper, you have to first score 40 marks. That is your BEP. Because unless you score 40 marks, you won't be able to clear the exam. And aggregate score should be 50% to clear the examination. So these are nothing but your BEPs, break-even point. You have to cross this. And this information is important for you because the moment you start writing the paper, the first in mind will be cross this and then stay as ahead as possible. score as more marks more than BP as possible naturally. But this information is important to you. Now a firm starts earning profit only after crossing break-even point. Now one more important information, my dear friends. Fixed cost is always treated as a period cost because this cost is attached to time period. It is also called as period cost, fixed cost. Like when I say factory rent is rupees 10 lakh per annum, it means the cost is 10 lakh for 1 year. So it is always attached to a time period because fixed cost doesn't change as per change in output. But if the period changes, it will change. The fixed cost for 6 months will be different, 3 months will be different, 1 year will be different. So fixed cost is also known as period cost. Now why I am saying this, if fixed cost given to you is for 1 year, the break-even point answer which you are calculating will be for 1 year. Means BP depends upon the period for which fixed cost is given. If in the formula of BP you take fixed cost of 6 months, then the answer of break-even point will be for 6 months. If you take the fixed cost of 1 quarter, then the break-even point answer will also be for 1 quarter. That is what you have to remember. So fixed cost is the period cost and BP is calculated for that much period for which fixed cost is given in the question. Now BP can be expressed or calculated in 3 different ways. Same BP but can be expressed or calculated in 3 different ways. One is in number of units, means how many units you should produce and sell to achieve BP, or another will be sales value, is what should be your sales revenue to achieve BP, or what should be the percentage capacity utilization of your plant to achieve break-even point. So in 3 different ways BP can be expressed: number of units to be produced and sold, or sales revenue, or percentage capacity of plant. Now the formulae are BP in number of units. Try to recall the formula from your memory. I think most of you are able to correctly recollect the formula. BP in units will be calculated as numerator total fixed cost divided by contribution per unit. So if total fixed cost is divided by contribution per unit, you will get the answer of BP in number of units. Now suppose we want the answer of BP in sale value, means in rupees sales, that is sales turnover. Then the formula will be total fixed cost divided by profit volume ratio, that is PV ratio. So if fixed cost is divided by PV ratio, the answer which you will get will be BP in rupees sales. If you want BP in percentage capacity, then again you have to take total fixed cost in the numerator, but you have to divide it by contribution at 1% capacity. Now you will say, how to calculate contribution at 1% capacity? So it is simple. Suppose the capacity of your plant is to produce 10,000 units. Capacity of your plant is to produce 10,000 units. Capacity means 100% capacity. Means at 100% capacity you can produce 10,000 units. Then if you operate the plant at 1% capacity, how many units you will produce? 10,000 units into 1%, you will get 100 units. So 1% capacity is 100 units. Now suppose contribution per unit is rupees 5. Suppose contribution per unit is 5. So on 100 units you will earn a contribution of rupees 500. So this rupees 500 is contribution at 1% capacity. As simple as that. Or you calculate total contribution at 100% capacity, that is 10,000 units all into 5 rupees. So you will get 50,000 rupees. 50,000 rupees is the contribution at 100% capacity. So what will be the contribution at 1% capacity? It will again come 500 rupees. But by this formula you will get the answer of BP in percentage capacity. At what capacity you should operate the plant to achieve BP. This information will be useful to the production manager. Now we'll write all the formula at one place. 3 formulas into one, all in one formula. Numerator is total fixed cost. I will discuss this word, desired contribution. Numerator is total fixed cost divided by either contribution per unit to get the answer in number of units, or your denominator will be PV ratio if you want to get the answer in sales rupees, or your denominator will be contribution at 1% capacity if you are interested in the answer of BP at in percentage capacity. So you can choose any one of the denominator, either contribution per unit or PV ratio or contribution at 1% capacity. So it's all written at one place. Now the important thing is the logic of writing total fixed cost in the numerator. My friends, total fixed cost and desired contribution is one and the same. I will say how. Suppose my fixed cost is rupees 50,000. Then in order to achieve BEP, means in order to reach to no profit, no loss, I should earn sufficient contribution which will exactly recover my fixed cost. If my fixed cost is 50,000, I should earn 50,000 contribution. So 50,000 contribution minus 50,000 fixed cost, my profit or loss will be 0. It means I should earn just sufficient contribution to recover this fixed cost. And we have just now seen few minutes before or few seconds before that at BEP, fixed cost is equal to contribution. At BEP, fixed cost is equal to contribution. So the formula is total fixed cost numerator. But for understanding, treat this total fixed cost as my desired contribution. Now suppose my desired contribution is rupees 50,000 because my fixed cost is rupees 50,000. And suppose my contribution per unit is rupees 50. Contribution per unit is rupees 50. So on 1 unit if I am earning 50 rupees, so to earn 50,000 rupees, how many units I should sell? I hope you are getting the logic. To earn 50 rupees, if I have to sell 1 unit, then to earn 50,000 rupees contribution to recover my fixed cost, how many units I should sell? So as simple as that, 50,000 divided by 50, and I think you will get 1000 units. So 1000 units will be your break-even point. So in the same way, you will get all the three. So numerator is logically nothing but desired contribution. Now we go further. Sometimes in the exam, they ask you to calculate the sales volume, which is required to earn desired profit. This desired profit will be given to you in the question, that we desire to earn so much profit next year. So what should be our sales next year so that we can achieve this objective or we can earn this desired profit? Now there is a formula for this. Formula is desired profit plus fixed cost divided by all the three again. All the three means any one of the three. Either you can divide by contribution per unit or PV ratio or contribution at 1% capacity. Now we have to just see the numerator. My dear friends, this numerator desired profit plus fixed cost is nothing but again desired contribution. It is once again desired contribution only. How come? Check our formula. Formula was contribution minus fixed cost is equal to profit. Now shuffle this formula. Contribution is equal to profit plus fixed cost. It means profit plus fixed cost is nothing but contribution. So this is what is written here, profit plus fixed cost. Desired profit plus fixed cost is nothing but a desired contribution. And again desired total contribution divided by contribution earned on 1 unit. You will get number of units to be sold to achieve that profit. So this logic and BEP formula logic is one and the same. Now if you divide this numerator by PV ratio, then you will get the sales in rupees. Sales in rupees to earn that profit. And if you divide the numerator by contribution at 1% capacity, you will get the sales in percentage capacity. Now I will show you here only the formula of BEP. In this formula only. In BEP there is no profit, no loss. So this profit or loss will become 0. It means numerator will become only fixed cost. Fixed cost divided by these 3 was the formula of BEP. Now add fixed cost plus desired profit. You will get this formula. Simple. And if there is a loss, then fixed cost minus loss, because loss is negative. Fixed cost minus loss again divided by these 3. You will get the same thing if there is a expected loss. So the logic of the formula is same. Numerator is nothing but your desired contribution. Now we'll take another formula to calculate profitability at a desired level of output. Meaning, in this type of question, the level of output will be given to you, the desired level of output. Like if I say that next year I am planning to sell goods worth rupees 25 lakhs. Means sales in rupees I have given. Next year I am planning to sell goods worth rupees 25 lakhs. how much profit should I expect? So sales manager is asking this question to a finance manager, that if I achieve a sales level of rupees 25 lakhs, how much profit do you expect? So we can calculate that profit using marginal costing. Or if the production manager says that next year I am planning to operate my plant at 75% capacity, then what is the profit you will expect? So production manager is asking a question to finance manager, that if I operate my plant at so and so level of activity, what will be the expected profit? All this answer can be given by you only, by using a simple formula. See, we want to calculate profit. This we want to calculate, and what is given to us is level of activity. Level of output means level of activity. See, to calculate profit, the formula is profit is equal to total contribution minus total fixed cost. This formula we have seen in the golden formula itself, that is contribution minus fixed cost is profit. So to calculate profit, total contribution minus total fixed cost, this is the basic formula. Now there could be different ways of calculating the contribution. For example, if in the question you are provided information about number of units, the number of units multiplied by contribution per unit, you will get total contribution. Number of units into contribution per unit will give you total contribution, and total contribution minus this total fixed cost, this one, you will get profit. As simple as that. Or if the data given in the question is in form of sales in rupees, so if you remember, sales into PV ratio, like sales into GP ratio was gross profit. So sales into PV ratio is nothing but again contribution, and contribution minus fixed cost, again you will get profit, provided this formula you will use if sales is given in rupees. Or if sales is given in percentage capacity, then percentage capacity into contribution at 1% capacity, this formula will again give you what? Total contribution minus total fixed cost. Once again you will get profit. Now let us discuss margin of safety. Margin of safety. Now before I discuss the concept, let us discuss from your exam point of view, that you want to score, let us say 50 marks in costing subject for BEP. Instead of 40 I am taking 50, that is for aggregate purpose. So you wanted to score 50 marks for break-even point in your cost and management accounting paper. But you have actually scored 78. This is your actual score. These are your actual marks, whereas BEP marks were 50. So how many marks extra you have scored over and above BEP? You have scored 28 marks extra over break-even point. These extra marks scored over break-even point is called margin of safety. So your safety margin is 28 marks. So the same example can be written in the formula pattern. First of all, it is the sales in excess of BEP sales. This margin of safety is a sales, first of all. My dear friends, mind it well, margin of safety is not profit. Margin of safety is sales, but it is the sales in excess of BEP sales. That is, sales over and above BEP sales is margin of safety sales. So you can say margin of safety is equal to total actual sales minus BEP sales. Actual sales minus BEP sales is margin of safety sales. Now if you want to convert this margin of safety in a ratio, sometimes in the question they tell you to calculate MOS ratio, that is margin of safety ratio, then you have to do this. Margin of safety sales, that is this answer, margin of safety sales divided by total actual sales, that is this one, this is the denominator, into 100. So you will get it in the ratio. Margin of safety sales divided by total sales into 100, you will get margin of safety ratio. If I put this data in your marks, your margin of safety marks were 28, but your actual score was 78. So 28 upon 78 into 100, right? Your margin of safety marks divided by your actual marks, right? So that is margin of safety sales upon actual sales. Into 100, you will get margin of safety ratio, right? If you use this formula. Now, margin of safety ratio I will explain using something else now. Actual sales will divide in two parts, BEP sales and margin of safety sales. See, actual sales minus BEP sales is equal to margin of safety sales. Similarly, actual sales minus margin of safety sales is equal to BP sales, and BP sales plus margin of safety sales is equal to actual sales. So actual sales can be split in two parts. One part is BP sales, another part is margin of safety sales. Now, BP sales divided by actual sales. If this is your numerator, BP sales, and this is your denominator, into 100, you will get BP ratio. BP sales divided by actual total sales is your BP ratio, break-even point ratio. And margin of safety ratio can calculate as margin of safety sales in the numerator, actual sales in the denominator. So margin of safety sales divided by actual sales into 100, you will get margin of safety ratio. From this you will understand one more thing, that BP ratio and margin of safety ratio are complementary to each other. BP ratio and margin of safety ratio are complementary to each other, and the total of these two ratios will always be 100%. Why 100%? Because denominator is always 100%. Your actual sales is the base 100. Of this sales is divided in two parts. So the total of two parts has to be 100%. It means in a question, if they give you that BP ratio is 80%, then margin of safety ratio will be 20%. If they tell you margin of safety ratio is 60%, then BP ratio will be 40%. So this is the information which you can use quickly. So you have to remember all this. This will help you to solve the questions quickly, that these two ratios are complementary to each other. Now there is one formula, net profit is equal to margin of safety sales into PV ratio. Now most of the students, they feel that net profit is equal to margin of safety sales. No. Net profit and margin of safety sales are different. Margin of safety sales into PV ratio is net profit. Margin of safety sales into PV ratio is net profit. Actually, sales into PV ratio is contribution. Indirectly, I am saying contribution earned by margin of safety sales is net profit. I repeat, contribution earned by margin of safety sales is equal to net profit. So net profit is margin of safety sales into PV ratio. Now we'll try to understand it through a calculation. Suppose I take total sales into PV ratio. Total sales into PV ratio will give me total contribution, correct? Total sales into PV ratio will give me total contribution. Now I will divide total sales in two parts. I will divide total sales in two parts. One part is BP sales, another part is margin of safety sales. And I will multiply both of them by PV ratio. So BP sales into PV ratio, I will get contribution at BP, and margin of safety sales into PV ratio, I will get contribution at margin of safety, correct? Contribution at margin of safety. But if you remember, at BP sales, whatever contribution we earn is exactly equal to fixed cost. So whatever contribution we have earned at BP, this contribution will go in recovering my fixed cost. Contribution earned by BP sales will be helpful in recovering the fixed cost, because at BP the contribution and fixed cost is same. Now then, whatever contribution is earned by margin of safety sales, this contribution earned by margin of safety sales will be my net profit now. Are you getting the point? Out of total contribution earned by me, the contribution earned by BP sales will be used to recover the fixed cost, and after recovering the fixed cost, whatever contribution is left or whatever contribution is earned by margin of safety sales is equal to net profit. Or you can see it like this also. This total contribution minus fixed cost is equal to net profit. This way also you can see. So the point of explanation was, this margin of safety sales into PV ratio results into net profit. That is what is written here above in the formula. Margin of safety sales into PV ratio is net profit. And my dear friends, by shuffling this formula, you will get two more formulas, like net profit divided by PV ratio. you will get margin of safety cells, correct? If I bring PV ratio to left side, or net profit divided by margin of safety cells. Net profit divided by margin of safety cells, you will get PV ratio. So all this can be, reshuffling can be done, and you will get multiple formulas if you wish to. Now let's go ahead. I am discussing some shortcut formulas, my dear friends. And to discuss the logic of shortcut formulas, I will take some data. Understand the data first. In one column, I am taking sales quantity. This sales quantity I have chosen as 10,000 units, 15,000 units. And the difference between these two, my last row is differential row. Difference is 5,000 units. Are you getting it? I have chosen two rows at two levels of activities. 10,000 units and 15,000 units is my sales quantity, and the differential quantity is 5,000 units. So first row is applicable for 10,000 units, second row is applicable for 15,000 units, and last row is the difference between first row and second row. Let us first understand data, then we'll go ahead. I'm assuming sales price as 10 per unit. So 10,000 units into 10 per unit, my sales will be 1 lakh rupees. 15,000 units sold at 10 per unit, my sales will be 1,50,000. And the difference between this sales, 1 lakh and 1,50,000, is differential sales 50,000 rupees. Is that okay? Now, I'll take this variable cost per unit 6 rupees. Variable cost per unit also remains constant. 10,000 units into 6 rupees per unit, my total variable cost is 60,000. 15,000 units into 6 rupees, my total variable cost will be 90,000. And 60,000 and 90,000, the difference variable cost is 30,000. I'm just explaining the data, then I will explain the formula. Now, sales price 10, variable cost 6, 10 minus 6, contribution per unit will be 4. Now, contribution per unit 4 rupees contribution into 10,000 units, my total contribution will be 40,000. And 4 per unit into 15,000 units, my total contribution will be 60,000. And difference in contribution, 40,000 and 60,000, differential contribution is 20,000. So last row is the difference between row 1 and row 2. Now, let's go to fixed cost. I'm assuming total fixed cost as 25,000. My dear friends, it will remain same because fixed cost doesn't change with change in output. This quantity has changed, but fixed cost will not change. So the difference in fixed cost is nil. Differential fixed cost is nil. Now, this contribution minus fixed cost, this minus this is profit. 40,000 contribution minus 25,000 fixed cost, 15,000 is profit. Now 60,000 contribution here minus 25,000 fixed cost, so 35,000 is my profit. Is this clear? First of all, I'm just clearing the data. Now check the difference in profit. Difference in profit, 15,000 and 35,000. Difference profit is 20,000. Now, let's go to total cost. Total cost is here this column, variable cost plus fixed cost. 60,000 plus 25,000. These two together is 85,000. Then 90,000 variable cost plus 25,000 fixed cost. 90,000 plus 25,000. Your total cost is 1,15,000. Up to this is okay. And check the difference in total cost. 85,000 and 1,15,000. The difference in total cost is 30,000. Just go through the data. I'll give you half a minute. Understand the data what I have written, because with this data I will explain four important formulas. Sales quantity in the first column, then differential quantity, sales revenue in second column, then differential sales revenue, and so on. I hope you have gone through it. Now, let us use this data and apply these shortcut formulas. I want to know variable cost per unit. This is what I want to calculate, variable cost per unit. So I have to take the change in total cost. Change in total cost means difference in total cost. My difference in total cost is 30,000. So change in cost upon change in output. Change in output means difference in output. My difference in output is 5000 units. It means the data is change in total cost is rupees 30,000 and change in output is 5000 units. Friends, if you divide 30,000 by 5,000, if you are keeping a calculator with you, you will get rupees 6 per unit. Rupees 6 per unit. My dear friends, 6 per unit is your variable cost. It was your variable cost per unit. So you'll get the variable cost per unit. Are you getting it? Now why it is working? Why it is working? Please remember, this total cost consists of two parts. One part is variable cost, one part is fixed cost. But you will notice fixed cost doesn't change. This has not changed. Then what has changed? Only variable cost has changed. This only variable cost has changed. So check carefully. This change in variable cost 30,000, this is reflected here in total cost. Change in variable cost is as good as change in total cost because fixed cost doesn't change. So in the numerator, in the formula, though we have written change in total cost, but what is changing is only variable cost. So can I say this change in total cost is nothing but change in variable cost? Delete this word change, common word. So variable cost divided by output. If you divide variable cost by output, naturally you will get variable cost per unit of output. That is how it works. So this formula is working because fixed cost is remaining constant. Now we'll take up the next formula, contribution per unit. Contribution per unit is equal to change in profit upon change in output. Change in profit upon change in output. Now let us see change in profit or difference in profit is 20,000. Change in output is 5,000 units. These two figures. So change in profit I am writing rupees 20,000. Change in output is 5,000 units. If you divide 20,000 by 5,000 units, you will get rupees 4 per unit. And I think 4 per unit was your contribution. This is your contribution, 4 per unit. So change in profit upon change in output, you will get contribution per unit. Now why this formula is working? Check carefully. See, this profit is calculated as contribution minus fixed cost. See, this is your contribution. This column is fixed cost. Now you will notice only contribution is changing with change in output, but fixed cost is not changing with change in output. Now check the change in contribution. Change in contribution is 20,000. However, change in fixed cost is 0. So don't you think entire change in contribution is affecting the change in profit? My dear friends, change in profit is solely attributable to change in contribution because fixed cost is same. So change in contribution and change in profit is one and the same. So instead of this change in profit, I can say it is change in contribution and remove this change word. So it will become contribution divided by output. If you divide a contribution by output, naturally you will get contribution per unit of output. I hope you are able to understand. So why these shortcut formulas work? These are called differential formulas or shortcut formulas. You can just understand the logic using this data because change in profit is entirely dependent on change in contribution because fixed cost is constant. Naturally, all these formulas will work with the basic assumption of marginal costing, that is total fixed cost will remain constant. With that assumption, these formulas will work. Now let's go ahead. PV ratio, if you want to calculate. So PV ratio is change in profit, that is this change in profit. Denominator is now change in sales, not output. Change in sales means 50,000 in 200. It means 20,000 upon 50,000 in 200. You will get 40%. Right? This answer will be 40%. And your PV ratio will be 40%. Reason? This 4 rupees contribution per unit divided by 10 rupees selling price. 4 divided by 10. PV ratio is 40%. Again, the logic is same, my dear friends. This profit is changing because of change in contribution. It is always equal. So in this formula, if I say change in profit is equal to change in contribution, and I remove the word change, then it will become contribution upon sales in 200. And contribution upon sales in 200 is the formula of your PV ratio only. And the last one, variable cost ratio. In the numerator, I am taking change in cost. Change in cost means total cost. This one, 30,000. Change in sales. Change in sales means this 50,000 into 100. So 30,000 is change in cost upon 50,000 is change in sales into 100. You will get 60%. So your variable cost ratio is 60%, and that is correct. Why it is correct? Check here. This variable cost per unit is 6 divided by sales price per unit. 6 divided by 10 will be 60%. So your variable cost ratio is 60%. And if you remember, just now we had calculated PV ratio 40%. PV ratio 40%, variable cost ratio 60%. They are complementary to each other. So if variable cost is 60%, PV ratio has to be 40%. Now once again, this change in total cost, this one, is attributable to change in variable cost. Only variable cost changes with change in output. Fixed cost doesn't change. So change in variable cost is the reason for change in total cost. So in the formula, in the numerator, if I say change in variable cost upon change in sales and I delete the word change, it will become formula variable cost upon sales into 100. And my dear friends, variable cost upon sales into 100 is the formula of variable cost ratio. Now these are quick or shortcut formulas, mathematically called as differential formulas, which can help you to solve the questions quickly if you remember these formulas. I tried to discuss or revise the logic once again of these formulas. One more thing, my dear friends, I have prepared a marginal costing flow chart which contains all the important formulas in one flow chart. You can simply take the printout on one A4 size paper. Our normal A4 size paper, you can take the printout of this flow chart for revision purpose. So if you want a flow chart with all the formulas at one place, then what you may do? You may do the following. You may visit my website with my name only. The website has the same name, CA-rakeshagrawal.in. Once you visit this website, you have to go to a tab on the home page only. You will find on the top row, you will find the tab Student Corner. The moment you click on Student Corner, you will find drop down options. In drop down options, you will select the option of CA Inter CMA. And in this option, you will find lot many PDF files, downloadable PDF files. So you can download that PDF file whose name is Marginal Costing Flowchart. So you will find a download PDF file. You can download it and take the printout. So you'll have in one flowchart, you will have all the formulas. Before entering the exam hall or a day before the exam, you can revise all these formulas or main concepts, and then you can go to the exam hall. Right. So the flowchart is already there on your website. I think this much is enough for the day, my dear friends. So we'll stop here for the day. See you tomorrow. Tomorrow we'll be discussing standard costing. Okay friends, bye bye.